Hello everyone, I'm Yali Zhang. Gold just hit new all-time highs this week, and silver broke through resistance levels we haven't seen in years. But within 48 hours, both metals dropped hard enough to trigger margin calls across commodity desks. The question isn't whether precious metals are volatile. The question is what that volatility is telling us about the deeper structure of these markets right now. And I'm going to show you why this isn't just noise. This is a signal. Before we go further, subscribe right now because what you're about to hear explains a shift most investors still haven't noticed. The mechanics behind precious metal pricing are changing, and if you understand what's driving this turbulence, you'll see opportunities others are missing. Let me walk you through the numbers first, because the price action alone doesn't tell the full story. Gold touched $2,900 per ounce earlier this week before pulling back nearly 4% in a single session. Silver spiked above $32, then retreated almost 6%. That kind of intraday swing in silver is not unusual historically, but the speed of the reversal caught a lot of traders off guard. Volume surged on both legs of the move. The rally wasn't thin. The sell-off wasn't either. That tells you real money was involved on both sides. Now notice what changed in the days leading up to this. The dollar index had been weakening steadily for 2 weeks. Treasury yields were compressing. Inflation expectations, measured by break-even rates on tips, were ticking higher. All of that created a favorable backdrop for precious metals. Gold and silver both respond to currency debasement fears, and when real yields fall, the opportunity cost of holding non-yielding assets disappears. So the rally made sense. It followed the script. But here's where it becomes important. The sell-off didn't happen because those fundamentals reversed. The dollar didn't suddenly strengthen. Yields didn't spike. What happened was profit-taking accelerated once algorithmic systems detected momentum reversals near technical resistance. In other words, the structure of the market itself created the volatility, not a change in the economic environment. That's a critical distinction. Look closely at this trend. Silver has been trading in a tighter correlation with gold over the past 6 months than it has in years. Historically, silver behaves like a hybrid. It's part monetary metal, part industrial commodity. When the economy slows, industrial demand for silver weakens, and it underperforms gold. When the economy accelerates, industrial usage rises, and silver can outpace gold on the upside. But right now, silver is moving almost in lockstep with gold. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been hovering near 85. That's elevated historically. It suggests silver is undervalued relative to gold, or it suggests the market is treating silver more like a monetary asset and less like an industrial one. Now let's talk about the physical side, because that's where the conviction is coming from. Exchange-traded funds backed by physical silver have seen consistent inflows over the past 3 months. Not massive inflows, but steady accumulation. Retail investors are buying. Institutional players are adding positions. The U.S. Mint reported strong demand for Silver Eagles in January. Dealers are quoting wider premiums over spot for physical delivery. All of that points to tightness in the physical market, even while paper prices swing wildly. And here's the thing about physical tightness. It doesn't show up in futures market data the same way. The futures market is dominated by financial players who trade contracts, not metal. They're hedging. They're speculating. They're managing risk across portfolios. Most of them never intend to take delivery. So when you see a sharp sell-off in futures, it doesn't necessarily mean anyone thinks silver is worth less. It means someone needed to reduce exposure, rebalance a position, or meet a margin call. The physical buyers, the ones actually taking bars and coins off the market, they didn't change their minds this week. They kept buying. Let me walk you through what's happening on the supply side, because this is where the structural pressure builds. Global silver mine production has been essentially flat for the past 3 years. There's no major new supply coming online. Most silver is produced as a byproduct of copper, lead, and zinc mining. That means silver supply doesn't respond quickly to price signals the way a primary metal might. If copper demand is soft, silver production stays soft, regardless of what silver prices do. Meanwhile, industrial demand for silver continues to grow. Solar panel manufacturing alone is consuming record amounts of silver. Electric vehicles use more silver per unit than traditional cars. 5G infrastructure build-out requires silver. These aren't speculative demand sources. These are structural, long-term demand trends that aren't going away. Now combine that with investment demand. When investors get nervous about currency stability, about inflation, about geopolitical risk, they buy gold and silver. That demand is episodic. It comes in waves. But when it comes, it's large and it's fast. We saw it in 2020. We're seeing hints of it again now. And if investment demand accelerates while industrial demand remains firm and supply stays flat, you get a setup where physical shortages become possible, even if futures prices don't reflect it immediately. But here's where it becomes important to understand how the futures market actually works. The COMEX silver futures market allows for significant leverage. A trader can control a large notional amount of silver with relatively little capital. That leverage amplifies moves in both directions. When prices are rising and sentiment is strong, leverage accelerates the gains. When prices start falling and margin calls hit, leverage accelerates the losses. This is why silver moves twice as fast as gold on a percentage basis. It's not because the fundamentals are twice as volatile, it's because the market structure is more leveraged. Now notice what changed in recent weeks. Open interest in silver futures, which measures the total number of outstanding contracts, has been elevated. That means there's a lot of positioning in the market. When open interest is high and prices move sharply, you get forced liquidation. Traders who are underwater on leveraged positions have to sell to meet margin requirements. That selling creates more downward pressure, which triggers more margin calls, which creates more selling. It's a feedback loop. And it can happen very quickly, disconnected entirely from what's happening in the physical market. So when you see gold and silver drop 4 to 6% in a day, ask yourself, did the fundamental case for owning precious metals change, or did the market structure create a technical washout? Most of the time, it's the latter. And that's why the volatility rattles nerves but doesn't change convictions. The people who understand the structural case for silver, they're not selling into this. They're waiting. Some of them are buying. Let me shift now to what this actually means, because the implications go beyond just price action. What we're seeing in the precious metals market is a reflection of deeper uncertainty about the trajectory of inflation, the credibility of central banks, and the stability of the financial system itself. Gold and silver don't rally because the economy is doing well. They rally because confidence in the currency is eroding. And when that confidence wavers, even temporarily, you get these sharp moves higher. Then when traders take profits or delever, you get the sharp moves lower. But the underlying concern doesn't disappear. It just goes quiet for a while. The volatility itself is information. It tells you the market is unsure. It tells you positioning is crowded. It tells you sentiment can shift quickly. But it also tells you there's real interest. Real money is moving in and out of these markets because real concerns exist. If no one cared about inflation risk, if no one worried about currency debasement, gold and silver would be dead markets. They're not. They're some of the most actively traded contracts in the world right now. And here's what that suggests about investment psychology. Investors are hedging. They're not abandoning risk assets entirely, but they're buying insurance. Gold and silver are insurance policies against monetary instability. The fact that those policies are getting expensive and then getting cheaper and then getting expensive again, that tells you the perceived risk is oscillating, but it's not going away. Now think about what happens if inflation proves stickier than central banks expect. If the Federal Reserve has to keep rates higher for longer, or if they cut rates and inflation reaccelerates, confidence in the currency takes another hit. In that scenario, the volatility we're seeing now is just the prelude. The real move hasn't happened yet, and that's why the people with conviction aren't shaken by a 6% pullback. They're looking at the bigger picture. Silver, specifically, is in a unique position. It's caught between its monetary role and its industrial role. If the global economy slows, industrial demand softens, and that's a headwind. But if currency concerns intensify, investment demand surges, and that's a tailwind. Right now, both forces are in play. That's why silver is volatile. It's being pulled in two directions. But if supply stays tight and investment demand keeps building, the path of least resistance is higher, not lower. Let me bring this together. Gold and silver just delivered the kind of volatility that forces weak hands out of the market and tests the conviction of everyone else. The fundamentals that drove the rally, concerns about currency stability, low real yields, geopolitical uncertainty, those haven't changed. What changed was the technical structure of the market. Overleveraged positions got flushed out. Algorithms detected momentum shifts and amplified them. That's market mechanics, not a fundamental reassessment. The physical market tells a different story. Steady accumulation, tight supply. Growing industrial demand, rising premiums for delivery. Those are signs of underlying strength, not weakness. And the fact that silver is trading at a steep discount to gold on a historical basis suggests there's room for silver to outperform if investment demand continues to build. What's happening in the silver market right now matters because silver sits at the intersection of monetary policy, industrial growth, and investment psychology. It's a small market relative to gold, which means it moves faster and harder in both directions. But that also means the opportunities are larger for those who understand the dynamics and can tolerate the volatility. So yes, the recent price swings rattled nerves. They were designed to. Volatility shakes out weak hands. It tests conviction. It creates opportunities for those who are prepared. But the structural case for owning silver hasn't weakened. If anything, the supply-demand imbalance is tightening. The monetary concerns are intensifying. And the market structure, as volatile as it is setting up for another leg higher when sentiment shifts back. Thanks for watching. Subscribe right now, share this with anyone who's trying to make sense of what's happening in precious metals, and stay alert. Because what's happening in the silver market right now matters more than most people realize. The volatility is the noise, the structure is the signal, and if you can separate the two, you'll see what's coming next.